Hi, welcome back to Westbury 101. I'm Brian Westbury, Chief Economist at First Trust Portfolios. Remember, we want to be the antidote to conventional wisdom. Well, first of all, I want to thank you. Our last video has been viewed 10,101 times. That's a new record for us. We're excited about that, and we invite you to invite all your friends to watch our videos as we produce them. This week I want to talk about really the intersection of government and the economy. You can't get away from that these days. And I want to deal with this from three different perspectives. First of all, worries about debt levels in our economy. Second of all, worries about the end of stimulus, the end of government spending, and whether the government's going to put more stimulus in or not. And third of all, I'd like to talk about the tax hikes that are likely to come next year. And specifically, I'd like to talk about Arthur Laffer's piece in the Wall Street Journal yesterday. So let's go back. Debt levels is where we want to go first. 53% of GDP. That's the size of our debt. The publicly held debt in 2009 looks like it's going to about 65% of our GDP for 2010. And the forecast is that we get to 80% of GDP, which is an extremely high level. We haven't seen since World War II period of time in about 10 years. And the question is are we going to turn into a Greece or a Hungary or an Ireland or a Spain or a whatever? And are we going to see a downgrade of our debt? Are we going to see real problems in funding our economy? And the first thing I want to do is, with all of the noise about this, with all of the worries, it kind of amazes me that our 10-year Treasury yield is 3.25%. And so if you really believed that this was going to be some massive problem, wouldn't you also expect to see Treasury yields above 3.25%? Well, that market basically is telling me today that while there's lots of noise and a lot of smoke, that there really isn't in the end any fire. The U.S. is not having any problems today funding its debt levels, and that sort of makes sense. Even at 80% of GDP, we're well below what would be a normal activity. You know, people borrow 200% of their income all the time to buy a home. Banks have no problem with lending 200% of someone's income to buy a house. Even today, believe it or not. And when you look at the asset of the United States, $150 trillion of actual assets, there's, remember, Yosemite and all kinds of government property that is worth trillions and trillions more. That's not even counted in that. We have $15 trillion in GDP or income. Having a debt load of $8 to $10 trillion literally is not a problem for us to fund. I do not believe we will be downgraded. There is no way that the United States will ever default on its debt. We can always print money to pay our debts. And if we're really worried about becoming a Greece, my belief is that if that's happening, it will not be for 20 or 30 or 40 years from now. And it will only be because we do not get our spending under control. And I can't imagine us, with the Tea Party movement out there and so many people upset about the size of government, that this kind of spending will continue for the next 2 or 3 decades. The second thing people are worried about is the end of stimulus. You cannot count me as one of those people. I believe that stimulus, in fact, has held our economy back. For example, cash for clunkers, we spent, I think it was $4.5 billion for trade-ins of old cars to get new cars. And that may have caused a pop in economic activity in the auto sector. Detroit, for example, loved it because it caused more cars to be sold. But in fact, every one of those dollars that was redistributed toward the car industry had to come away from some other industry. There is no such thing as a free lunch. This is what Milton Friedman taught us. So we lost a job in Seattle, Washington, even though we were able to save or create a job in Detroit. We lost a job in Minneapolis, Minnesota, or Austin, Texas, even though we were able to shift economic activity to Detroit. And in a temporary kind of manner, it can make things look better, but in fact, there is no improvement. And my belief is that all this shifting of income harms the economy. We would have a much stronger economy today if it weren't for the stimulus that was out there. And my belief is that as that stimulus dies down and goes away, that in fact the economy will continue to strengthen. The third thing people are worried about is tax hikes that are coming next year. And the key thing is coming next year. Art Laffer wrote a piece in the Wall Street Journal. He said we're going to have a recession next year when tax rates go up. He said it's, in fact, as people, and we know this, supply siders have taught us this over the last 20 or 30 years, that when tax rates are about to go up, people shift income into the period before that. So 2010 is going to have more income and more profits and stronger growth than 2011 because taxes are going to go up next year when the Bush tax cuts end and tax rates go back to their previous levels. The question is do we have any period of time recently that we can look at to determine what kind of impact this might have? And I have looked this up. Back in 1990, the top tax rate was 28%. It went to 31% in 1991 and 92. And then Clinton raised it to 39.6% in 1993. What's fascinating is if we go back and look at GDP in 1990, it was 1.9%. We had a recession in 1991, minus 0.2, and then in 92, 93, and 94, GDP was 3.4%, 2.9%, and then 4.1%. So if you can call slowing down from 3.4% in 1992 to 2.9% in 1993, the impact of a tax hike and a double-dip recession, bring it on any day. Next year, tax rates are scheduled to go from 35 to 39.6%. This is the top marginal tax rate. It should have less of an impact than the 1992-1993 tax hike had. And as I said, the economy continued to grow from 92 into 93 into 94. The reason that was true was because even though tax rates were going up and conservatives and punditry was telling us that we were going to have the Clinton recession, the Federal Reserve at the time was very easy, holding interest rates at 3%, which was literally at or slightly below the rate of inflation. With interest rates now at 0 and highly unlikely to be raised this year, my belief is that we are not going to see a double dip as we turn into 2011. Now, don't get me wrong. Tax hikes will slow the economy over time. It will cut down on inventiveness, innovation, creativity, and entrepreneurship. We will pay a price for higher taxes and a bigger government over the long run. But the impact in the short term will be overwhelmed, in my view, because of Federal Reserve policy. As a result, the V-shaped recovery will continue, and even though I don't like the direction of debt, the direction of spending, the direction of taxes, the economy will continue to grow, even though these things are scheduled to roll out over the next few years. Remember, we want to be the antidote to conventional wisdom. Thanks so much for visiting this time. See you next time. Bye-bye.